The dollar's last dance. What does it actually mean for a currency to lose its place at the top of the world's financial system? Would we even recognize it if it was happening? For the last 80 years, the US dollar has held the top position. Central banks around the world hold it in reserve. Oil gets priced in it. When a crisis hits almost anywhere, money tends to flow towards the dollar, not away from it. That position is known as reserve currency status, and no other country has held it as completely or as long as the United States has. The dollar has never been seriously threatened until recently. In 2022, the United States froze nearly $300 billion belonging to Russia's central bank almost overnight, simply by cutting Russia off from the banking system the rest of the world relies on. Every other country watching took note. Since then, central banks from Warsaw to Beijing have been buying gold at a pace not seen in decades. The United States' own debt has climbed past the size of its entire economy, and a handful of governments have started quietly building financial systems that don't run through Washington at all. None of that means the dollar is finished, but it means the conversation has changed, and understanding why starts with a basic question most people have never actually had answered. What makes a currency a reserve currency in the first place? A reserve currency is not something a country applies for, and it is not selected by any vote or international body. A currency takes on that role because it solves a practical problem shared by nearly every country engaged in international trade. The problem is straightforward. When two countries trade with one another, they need to agree on what currency the payment will be made in. If that currency is stable, easy to convert, and backed by deep, trustworthy financial markets, something else tends to happen as well. Other countries began holding some of that currency in their own reserves, not to spend day to day, but to keep on hand, in much the same way a household keeps savings set aside for an emergency. That comparison holds up under scrutiny. A household keeps its emergency savings in something stable, because if its own income becomes unstable, it needs a cushion that isn't subject to the same risk. Countries operate under a similar logic. They cannot hold their emergency reserves in their own currency, because if their own currency runs into trouble, their own currency is often the very thing losing value at that moment. So governments hold their reserves in a currency the rest of the world trusts, even when their own domestic situation becomes difficult. This role has changed hands more than once. For a long stretch, it belonged to the British pound. Before that, the position was held by the Spanish silver dollar, and before that, the Dutch guilder, and further back still, the Venetian ducat. Every one of these currencies eventually lost the position. Reserve currency status has never been a permanent feature of any single nation. It is inherited, held for a period of time, and eventually passed on to whoever comes next. It is inherited, held for a period of time, and eventually passed on to whatever comes next. Back to the aftermath of the Second World War, a starting point that's often skipped over in casual retellings of this history. In July of 1944, representatives from 44 countries gathered in Bretton Woods, New Hampshire, to design a new international monetary system. The circumstances of the moment made the outcome fairly predictable. Europe's industrial base had been devastated. Japan's economy was in ruins. The United States, by contrast, held close to half of the entire world's economic output. No other economy was in a position to anchor a new global system. The agreement reached there reflected those conditions. The dollar was pegged to gold at a fixed rate, and every other major currency was pegged to the dollar in turn. For roughly 25 years, that arrangement functioned largely as intended. By 1971, the arithmetic behind it had stopped working. The United States had been spending heavily abroad for years, and its gold reserves were depleting faster than the system could sustain. Other countries began exchanging their dollar holdings for gold, exactly as the original agreement permitted. There was no longer enough gold on hand to honor those requests at the promised rate. In response, President Nixon ended the dollar's convertibility into gold, announcing the decision on television in August of that year. From that point forward, currencies were allowed to float freely against one another for the first time in decades, with no fixed anchor holding the system in place. This moment, often called the Nixon shock, tends to get passed over quickly in popular accounts of the dollar's history. Yet, it stands as one of the most consequential turning points in the modern history of money. The next part of this history is where the popular version of events strays from details. However, these details are necessary to our understanding of the current position of the dollar and where it is heading. A familiar version of this story holds that the United States secured a secret agreement with Saudi Arabia in the 1970s, guaranteeing that oil would be priced exclusively in dollars forever. It claims that this single agreement explains the dollar's dominance ever since. It is a tidy explanation. It is also not an accurate one. A real arrangement was signed in 1974, formally describing as a Joint Commission on Economic Cooperation, focused officially on military assistance. Underneath that official framing, a looser understanding existed. Saudi Arabia continued pricing its oil in dollars and invested a significant share of its oil revenue into U.S. Treasury securities. In exchange, it received American military support. Historians who have reviewed the declassified records are clear that this was never a binding contract obligating Saudi Arabia to anything. In fact, oil was already being priced in dollars before this agreement existed. That practice grew out of the dollar's existing dominance rather than creating it. The broader claim that Gulf nations were obligated to continuously reinvest their oil revenue into American assets has also been overstated, according to economic historians. By the early 2000s, researchers examining Saudi Arabia's accounts found that its surpluses and deficits over the preceding decades had roughly balanced out. Some may believe that if this agreement is the foundation of the dollar's dominance, and if it were to dissipate, then the dollar's power would collapse. This is a misplaced belief. The actual foundation of dollar dominance was never that agreement. It rests on something more fundamental: deep and liquid capital markets, a stable and predictable legal system, and a multi-decade head start that no other economy has matched. That foundation can erode over time, but it does not erode because one informal arrangement from the 1970s changes. The most significant recent development in this story has nothing to do with oil or Saudi Arabia. It concerns the use of financial access as a tool of foreign policy. In February of 2022, following Russia's invasion of Ukraine, the response from Western governments went beyond conventional sanctions. Several major Russian banks were removed from SWIFT, the messaging network that banks around the world rely on to process cross-border payments. SWIFT functions as the infrastructure that allows one bank to tell another bank anywhere in the world that a payment has been made. Losing access to that network isolates a country from most of the global financial system almost immediately. At the same time, Western governments froze a substantial portion of Russia's foreign currency reserves, estimated at close to $300 billion. The decision was made and implemented within roughly a week. None of this was entirely without precedent. Iran had been removed from SWIFT years earlier. But applying this measure to one of the largest economies in the world was new, and governments watching from outside drew a consistent conclusion. Access to the dollar-based financial system is not a neutral, apolitical utility. It is American-controlled infrastructure, and it can be restricted for any country, at any time, based entirely on American foreign policy decisions. Once that lesson became clear, governments around the world began building alternatives, deliberately and methodically. Russia expanded its own domestic payment messaging system, called SPFS, which now connects several hundred financial institutions across more than 20 countries. China developed a comparable system called CIPS, which now processes several $1 trillion in transactions annually. Neither system approaches SWIFT's scale or its level of international trust. The size of these systems, however, is not the most important detail. What matters is the underlying motivation. Once a country has watched another country lose access to a critical financial system, It has a clear incentive to build a backup, regardless of whether that backup is currently competitive. That motivation does not disappear once a particular conflict ends. It has become a permanent consideration in how governments approach financial security, a shift in thinking that did not exist in the same way before 2022. A second pressure on the dollar's position has nothing to do with sanctions or foreign policy. It concerns the size of the United States' own debt. The U.S. federal debt is currently measured in the tens of trillions of dollars, and the figure has grown larger every year for decades running. That trend has held consistently for a long time, and no realistic projection shows it reversing in the near term. The scale of these figures is difficult to grasp intuitively. $1 trillion is hard for almost anyone to picture concretely, which is part of why public attention to these numbers tends to fade over time, even as the underlying trend continues uninterrupted. What matters more than the raw figure is the debt measured against the size of the economy as a whole. By that measure, U.S. federal debt now exceeds the country's total annual economic output, and current long-term projections show that ratio continuing to climb for at least the next decade. This raises an important question. Does rising debt automatically undermine global confidence in the dollar? Not on its own, at least not so far. The United States has carried a net foreign debt for decades, and historically, it has earned more income from its overseas assets than it pays out to its foreign creditors. That has functioned as a meaningful cushion, but the cushion depends entirely on continued confidence. There are already early indications of that confidence wavering. Foreign holdings of U.S. debt have continued to grow in absolute terms, but they represent a shrinking share of a debt load that is growing even faster. Some of the largest holders reduce their exposure during periods of financial stress, then often increase it again afterward. This pattern does not indicate abandonment. It reflects gradual diversification at the edges of the system, comparable to an investor who maintains a position but stops adding to it. This raises an obvious question. If the dollar's position is under pressure, what is actually positioned to replace it? The evidence points to nothing, at least not yet, and not convincingly. The Chinese yuan, often discussed as the most likely challenger, still accounts for only a small, single-digit share of global reserves. The euro is a genuinely stable and well-regarded currency, but it carries a structural limitation that is frequently overlooked. There is no single unified Eurozone bond market the way there is a single U.S. Treasury market, and no one institution stands behind the euro the way the Federal Reserve and the U.S. Treasury stand behind the dollar. There is also the BRICS bloc, made up of Brazil, Russia, India, China, and several more recently added members. The bloc has floated proposed cross-border payment systems, agreements to settle trade in local currencies, and a gold-link currency concept that has drawn considerable attention online. As things currently stand, each of these remains a pilot program, a proposal, or a limited test, rather than a functioning alternative to the existing system. Even within the bloc, there is no consensus that replacing the dollar is the actual goal. India, one of the bloc's founding members, has stated publicly that it sees no benefit in pursuing that outcome. What would it genuinely take for a credible alternative to emerge? The historical record points to 3 requirements, each difficult to meet quickly. First, an economy needs deep and liquid capital markets, meaning a place where foreign governments can hold very large sums of money with confidence that they can access it when needed. China does not currently meet this standard. Its capital controls remain restrictive, and international trust in its financial system is still limited. Second, an economy needs full currency convertibility, meaning the currency can move freely into and out of the country without significant restriction. No current rival currency offers that combination at a scale comparable to the dollar. Third, and this requirement is often underestimated, an economy needs time. Reserve currency status is built through decades of consistent, predictable behavior, not through a single policy announcement. The British pound took over a century to fully lose its position at the top. Nothing currently underway is moving anywhere near that pace. One development in this space is measurable and real rather than speculative, and it is worth separating clearly from everything else under discussion. That development is the recent surge in central bank gold purchases. Central banks, particularly those concerned about facing sanctions themselves in the future, have been purchasing gold at a pace not seen in several decades. The reasoning behind it is straightforward. Unlike a bank deposit or a foreign currency reserve, gold cannot be frozen by another government's decision. It is not a currency competing to replace the dollar. It functions instead as a form of insurance, a hedge against the possibility that the financial system could be used as a tool of pressure the same way it was used against Russia. That is a more modest claim than predicting the dollar's decline, but it is a real and well-documented trend. The effects of a gradually eroding dollar position would not arrive as a single dramatic event. They would surface as a slow drift through the broader economy. Imported goods would tend to become somewhat more expensive, as the dollar purchased less abroad than it once did. Borrowing costs for the U.S. government would tend to rise, since a smaller pool of eager buyers means the government has to offer higher interest rates to attract the buyers who remain. Those higher borrowing costs eventually filter down into mortgage rates, auto loans, and consumer credit more broadly. Industries directly tied to trade, shipping, manufacturing, and finance would likely feel these shifts fairly quickly, through contract terms, narrowing margins, and hiring decisions made at the corporate level. Workers outside those industries would still feel the effects, though more indirectly, through prices at the store and through the value of retirement savings invested in markets tied to the dollar. None of this tends to show up clearly within a single news cycle. It unfolds over years, quietly, as a part of the ordinary background of economic life. That is precisely why the public tends to misjudge how seriously to take it. The signal moves too slowly to trigger genuine alarm in the moment, but quickly enough over time to matter a great deal. So where does this all leave the dollar's position? Most likely, somewhere fairly unremarkable. Not collapse, and not permanent stability either. A slow and uneven redistribution of trust occurring at the margins of the system, while the center of that system still has no genuine substitute ready to take its place. The dollar's dominance was never really built on a single oil agreement or a long-expired gold peg. It was built on functioning as the most reliable available option in a world that requires somewhere safe to hold its savings. That basic calculation has not shifted decisively for any major economy yet, but a growing number of countries are quietly preparing for the possibility that it eventually might. The evidence, taken together, supports neither extreme version of this story. The dollar is not dying. It is also not invincible, regardless of how often that claim gets repeated with confidence. Every dominant currency in recorded history has eventually been challenged by whatever came next. That is not a specific prediction about the dollar. It is simply the pattern history has demonstrated before, repeated across centuries. The more useful question is not whether this eventually happens to the dollar too, since history suggests that it will. The more useful question is what that transition actually looks like while it is happening. Who feels the effect first? Who bears the cost? Who benefits? And whether the shift would even be recognizable in real time, or whether, as with most transitions throughout history, it would only become clear in hindsight, the way 1944 and 1971 are now understood as turning points without much hesitation. The world may be living through the early stages of the next dominant currency right now. However, there is, at present, no way to know that with any certainty. What remains measurable, in the meantime, is the structure underneath the headlines, the pace of gold purchases, the trajectory of sovereign debt, and the countries quietly building financial alternatives, and why. That is where the story is actually taking shape, not in any single panic, but in the pattern beneath it.